Hello and welcome to the Saffery Private Wealth Podcast. I'm Leonora Stevens, a private wealth partner based in Bristol. I'm joined by Mike Hodges, a fellow private wealth partner based in our Manchester office. Hello, Mike.
Hi, Leo.
We are delighted to be joined today by Alex Britton-Davis, a partner in our international private client team. Welcome, Alex.
Hi, Leo. Hi, Mike.
Join us each episode for in-depth discussions on private wealth matters, from estate planning to trusts and retirement and gifting strategies. We're here to provide practical tips to help grow and protect your wealth. And please don't forget to subscribe on your preferred podcast platform. Today, we're looking at a topic that comes up more and more often with clients and intermediaries alike. What happens from a UK tax perspective when someone moves abroad for work? That might be a short-term secondment, a new role overseas, a move to join a partner, or simply a personal decision to relocate while continuing their career elsewhere. It sounds straightforward. You move, you leave the UK behind, and your UK tax position ends. But as many listeners will know, it is rarely that simple. Questions around UK tax residence, split year treatment, ongoing UK filing obligations, tax on your UK income, capital gains, double tax relief, and national insurance can all come into play. As with many of our pods where we have an international focus, we asked Alex to come and join us today as she advises internationally mobile individuals and families on cross-border personal tax issues. So before we go into any detail, I do think it's worth saying that today's episode is intended to be quite a high-level summary because these rules are really highly fact-specific, and so people should always take advice on their own circumstances.
Yeah, that's absolutely right, because two people could leave the country, leave the UK on the same day and end up in totally different circumstances depending on things like work pattern, where the families are, have they got homes in the UK and their foreign location or both, how often they come back, all those sorts of things. I was with a friend of mine at a dinner last night and he lives in Germany. I think I mentioned him to you, Leo, yesterday when we were together, and he said he had a panic a couple of years ago when he'd got his day counting slightly wrong and for a horrible moment thought, how have I done? So it's hugely fact specific and very, very sensitive. So it's good to have Alex with us. I was going to start, Alex, just talking about why moving abroad isn't as simple as I've gone there from, I'm not UK resident, as Leo started. And with a big misconception, I'm on the plane, that's it, I'm gone. I can wash my hands of the UK because I'm now heading to sunnier climes and that's all I have to worry about.
Exactly. So the UK's residence is based on our statutory residence test, or SRT, and it's a series of quite detailed and structured tests that you have to apply. So as you say, it's not just a simple case of I've got off the plane in another country, I'm resident there now. You have to look at your days in the UK, certain ties to the UK, accommodation, family, work patterns, etc. So yeah, very important that you do correctly apply the test.
And that's a legal test, is it?
Yeah, so we used to have a slightly sort of woollier set of tests where it was basically if you were here 183 days, you were a resident, but if you were here less than that, it was sort of all based on case law. When they introduced the SRT, it's a very strict, you're either resident for the tax year or you're not, which obviously we have our nice weird tax year running from the 6th of April to the 5th of April. And then if you are resident for a year, which is very common in the year someone leaves the UK, you can then apply what we call the split year test. So again, it's more tests that you have to look at, follow the rules, look at all the criteria.
Yeah, so in general terms, just to labour my point, if I leave the UK in September, I'm not automatically non-resident from that date in September.
Exactly. So if you leave in September, there's a good chance you've been in the UK long enough that you'll be UK resident for the whole of the tax year till the following 5th of April. But then we could have a look at, do you qualify for split year treatment?
And can you go into a bit more detail about when do people get split year treatment and sort of on what basis they can claim that and what does it actually mean?
Yeah, so split year treatment is broadly a test that says, look, you've left the UK partway through the year. If you meet these criteria, what we'll do is we'll split the year into the first part where we'll tax you as a resident and the second part where we'll broadly tax you, not completely, but broadly tax you as a non-resident. And there are sort of 3 criteria by which you can get that treatment as someone leaving the UK. So either because you are moving to work full-time abroad, you're the partner of someone working full-time abroad, or you're ceasing to have a home in the UK. Now, obviously, someone might meet all three of those criteria, in which case there's an order of priority. But the key thing is those are quite specific rules to meet. And the really critical thing is you have to be non-resident for the following tax year, for the whole of the tax year, to meet any of those. So it works well for someone moving for a reasonable period of time, but it doesn't work if you're just moving away for, say, 6 months to 12 months.
Yeah. But if you hit one of those three tests, then it's very valuable because your overseas income isn't going to be taxed in the UK. Again, I like oversimplifying all this, so tell me if I'm oversimplifying, Alex.
Yeah, that's exactly it. So as a non-resident, typically you won't pay any tax on your sort of foreign income and gains. The UK doesn't tax citizens like, say, the US or something does. So yeah, once you've left the UK, assuming that employment income is, let's say you move to Dubai and you're being paid by a Dubai company to work there, that should then all fall outside of the scope of UK tax if you get the split year treatment.
Yeah.
So if we talk about your person who's just moved to Dubai as an example, so if someone was working in London and they were seconded to Dubai from, say, the 1st of September, initially for a 2-year role, they keep a property in the UK, their spouse stays in the UK to sort of look after the kids, and they come back to the UK regularly for meetings and family visits. What should that individual be thinking about?
Yeah, so we see this example quite a lot, I think. And one of the really useful tests in the SRT and the split year treatment is for people working full-time abroad. So when you look at a full tax year, that is someone who is working an average of at least 35 hours a week abroad. So, a usual working week. They can't have any significant breaks from that work. So, for example, if they were changing jobs and had a bit of a break, that could cause a problem. And the key is that they only spend limited time in the UK. So, under the test for a full year, that's 90 days presence in the UK, counting days at midnight, and up to 30 UK work days. So, that's a day on which you do more than 3 hours of work in the UK. Where you're looking at the split year, it's broadly the same test, but you prorate that 90 and 30 days. So if you're only here for half the year, so if you're splitting the year halfway in the middle, it's broadly 45 days presence and 15 work days. So that gives you a nice clear limit of how much time you can spend in the UK. And as long as you meet those tests, you'll be non-resident. So it won't matter that your family is still here, that you've still got a house here. You can come stay with your family when you're here. They can come stay with you. So that's a really nice test for those people who are planning to work abroad.
Is there one sort of overall practical message you can give people? Because there's loads of detail, as we keep saying, without apologizing. But any simple practical messages?
Yeah, I think it is know what your limits are, so know what those day counts are, and then keep the records. If HMRC ever inquire, you'll need to demonstrate how much time you spent in the UK, how much time you spent here working. That can be quite tricky to prove you weren't working, but as best you can, have good records and have those records to demonstrate that you're working abroad. So often that is, look, you've got a full-time work contract. Your contract says you need to be based in your office in downtown Dubai. You can see that there's not that much time spent outside of those places other than what's allowed in the UK and your usual holidays. That should be quite good evidence that you are actually working full-time abroad. If you are spending a lot of time in the UK, because you can potentially have up to 90 days here, but only 30 work days, what are you doing on those other days? If you are here visiting family, it's typically at weekends. That's going to be better evidence. And if you're spending significant weeks here, which would normally be working hours, then you might need to sort of prove that you weren't working and what you were doing instead.
The thing with all of that, though, it's trying to keep those records as you go along. That's always we always say with lots of our podcasts, it's always about keeping good records. But if you do it as you go along, it's less difficult than if in a year's time HMRC say challenge, so can you prove it? And also I think the working whilst in the UK point is important, because I think I was watching calls recently and they were talking about how people are in the UK and then they might sit in their UK office if it's a multinational company, but they said they weren't working, but they were using the desk space. So it's just sort of making sure that they can clearly identify what they're doing and they're not breaching those workday ties as well.
Yeah, absolutely. And certain things people forget about, like travel time. So if you're traveling to a meeting for work and that is a journey, broadly, the rule is if you could expense that travel ticket, then the travel time is probably work time as well. For us accountants who do timesheets, it's nice and easy because we probably have a timesheet demonstrating exactly what we were doing. But that's not the case for most people. But yeah, that's something that can easily be forgotten. Dinners with clients or work colleagues, those sorts of things can count as work. And I'd say when people are on their phones doing emails, it can be quite difficult to prove if you're sending, one email at 9 a.m., another at 11 a.m., and another at 3 p.m. Were you really working for less than 3 hours? Possibly, but it's difficult to prove that.
So we're advocating that clients do timesheets. That's going to make us popular, isn't it?
Not sure I'd want to put that on anyone else.
No, absolutely not. The bane of professional life.
So if we've obviously we've said about people getting on the plane and then thinking about their residency status, if they have become non-resident, does that mean what do they have to think about from HMRC's perspective and the UK tax system?
Yeah, so particularly if they're getting split year treatment, so filling in their tax return correctly. So there are residence pages on the return where either if you're non-resident or you're claiming split year treatment, you would fill those in. So putting in the necessary information in terms of your days, etc. One in the following year, when you are non-resident for the full year, whether you need to file a return or not will depend on whether you have any UK source income. So, for example, if you leave the UK and start renting out your UK property, you'll have UK rental income. You might just have other sources that need to be reported. Again, you'll need to fill in your return to say I'm non-resident and here's the relevant details, and then include your UK source income only.
Okay, so you can't just apply to HMRC. So that's something people need to keep in mind. And then another point that some people might wonder about is about dual residence, double tax treaties. If they're regarded as resident in the UK and the new country, for example, what happens there? And do they get taxed twice?
Yeah, so it's very common to see dual residence for at least a period. I've said we have this weird tax year that no one else has. So there normally will be periods of overlap with another jurisdiction. In that case, we do have a double tax treaty, which essentially says, okay, for the purpose of the treaty, we'll treat you as resident in either the UK or the other jurisdiction. And that sort of determines who gets primary taxing rights in terms of different sources of income. If you do get split year treatment, typically that means that sort of whilst you're in the UK working here, you'll be taxed as UK resident under the treaty. And then for the remainder of the year where we're treating you as a non-resident, you'll be taxed in the other jurisdiction. So again, it's things like who can tax your bank interest, etc., might switch partway through the year. Generally, with the employment income, if you move employer, or say you were working for the London office, now you're working for the Dubai office, if you're working for that employer in Dubai, doing your work in Dubai, Dubai will have they'll have the primary taxing rights. So even if you're still UK resident, the UK will normally give you credit for any tax paid in Dubai on that income. Might not be enough to completely frank your UK tax on the income, but you shouldn't pay tax twice.
So you're talking about treaty residence, which is a techie term, isn't it? Being different from normal, if there's such a thing as normal domestic residence.
Yeah, so we see this particularly for people who don't manage to get split year treatment for whatever, they don't quite meet the criteria. If you move from the UK abroad, you might then still be treaty resident in that other jurisdiction because of the terms of the treaty say, yes, you're working over here, you're living over here, your home is over here. If you do say leave the UK, but your spouse, your children don't, you keep a home in the UK, you still have more ties to the UK, you might actually remain treaty resident in the UK because those types of ties, it's what we call the centre of vital interest, is the term used, remains in the UK, in which case, as I say, if the work's being done abroad and you're working for that company in Dubai and you're doing your work there, they'll still get to tax your employment income, but it will remain taxable in the UK, but with a credit. So it's really important to understand where you are resident, in which periods in each jurisdiction. Are there any overlap periods? And in that overlap period, where are you resident per the terms of the treaty, because that will determine what's taxable where, who needs to give credit for what, and what you need to put on your tax return. So even if there's no tax due on it, you might still need to report it to claim foreign tax credits, etc.
Excellent. So far, we've talked about income, but what about capital gains? Because I think, again, a lot of people think, I leave the UK, I've got assets I sell them when I'm not here. There's no UK capital gains taxes, or I can ignore the UK because I've gone off to wherever, and I just look at Dubai. Seems to be the example we're picking on.
Yeah, it's not always the best example because they don't necessarily tax everything.
That's why people see it as sort of the land of milk and honey, don't they?
Exactly.
But in general terms, if you've just left, sell your asset, don't have to worry about UK tax. Can it ever be that simple? And I guess that our listeners will guess where we're heading with that example.
Yeah, so the UK, if you're non-resident, you'll only ever be subject to capital gains tax if you sell UK property. So any land and real estate, including sort of indirect interest as well. So if it's owned through a company and you sell the company shares, that does mean that everything else, so all foreign assets, but also other UK assets, so for example, shares in UK companies, etc., aren't taxable for non-residents. That obviously potentially would open up quite a nice squeeze for people to sort of move abroad for a year, realise all their capital gains and then return. So we do have some anti-avoidance rules known as the temporary non-residence rules. And broadly they apply if you have been living in the UK and you leave for a temporary period, which is 5 years or less. So generally, to help people avoid these, we typically say plan to be non-resident for 6 full tax years, and then you're definitely outside of those rules. If you are temporarily non-resident and you sell an asset, that capital gain will be taxable in the year you return to the UK. So as I say, not necessarily a reason not to sell assets if investments decisions say that's the right thing to do, but it just means that you will be taxable when you return. As I say, and if you have paid tax in the foreign jurisdiction, you should be able to get credits, etc.
Yeah. So again, if you've been abroad for 3 years and you sell your company shares, your shares in the company you own in the middle of that period, you're not necessarily going to escape CGT.
Yeah, exactly. And it's only gains on assets that you owned whilst UK resident. So if you have bought, let's say you buy a flat in Dubai and you sell that whilst you're non-resident, that gain shouldn't be caught. Similarly, some types of income are caught. Broadly, they're the ones you can control. So if you have your own company and you pay yourself a dividend, that's caught. If you've got shares in a listed company and that pays a dividend, that's not caught. Similarly, your simple interest on your bank deposit, that won't be caught. But the things you can control, like pension distribution, like distribution from a company you own, can also be caught by these rules.
So I suppose the key again is record keeping, isn't it? Is if you do think you're going to be away for 6 years, but then something happens that means you have to come back early, for example, a sick relative, and you end up relocating back to UK, you've then got to report that in your return on the year that you return.
Exactly. And what we do see is if people are thinking, oh, I might take advantage of my non-residence period and sell something, they might wait a few years, not do it on day one when they've just left the UK, but wait a few years until either they're settled abroad so they know they're going to remain there, or perhaps they're coming up to the end of their 5-year period, so they're comfortable they're going to exceed those 5 years.
Yeah, so that planning required before you dispose of it instead of when you're on your plane back, relocating back to the UK.
Yeah, because I wonder how many people only discover it when it's too late and they're back and they're doing a tax return. It's all, oh yeah.
Yeah, exactly. And a lot can change in 5 years, can't it? You can have best laid plans.
Because real life gets in the way, doesn't it?
What about if the rate of CGT changes? Would the rate of CGT be applicable at the date of return or at the date of they initially disposed of it if the rate goes up?
Yes, the date of return. So it's the disposal is treated as arising in the year you return. So that would be the applicable rate. So potentially you could have a higher rate of tax than if you've been resident.
What about national insurance? What should people think about that?
Yeah, so national insurance is often overlooked. The sort of starting point is broadly you pay social security or national insurance in the country where you're working. But we do have agreements with a number of countries, which broadly means that if you're sort of in another jurisdiction for only a temporary period, you continue paying in the UK. It varies slightly depending on which jurisdiction you're looking at. And what you do is you get a sort of what we call a certificate of coverage from the UK government that says, yeah, they're still going to be paying it here, so you don't need to pay it overseas. And broadly the reason why that is because typically national insurance gives you sort of each year you pay it, that's a year towards you getting your state pension, etc. There's no use you having 3 years of having paid social security in another jurisdiction where you're never planning to take a pension. So instead you carry on paying it in the UK.
Great, thanks. I suppose on a sort of coming to the close, what would be your practical checklist before people think about moving abroad?
So I think the first is always get the advice before the move. That means you'll know, are you going to have that split year treatment or not? You'll know what your limits are in terms of days in the UK, so you can plan for it. And you can also potentially plan the date of leaving so that you have that certainty that this is the date from which I'm taxed as non-resident. Second to that, as we mentioned, keep the records, keep those boarding passes, keep that sort of work calendar, keep the calendar of what you're doing when you're not working in the UK so you can demonstrate that. And then I think third is sort of think about, okay, I'm going to be non-resident, but what do I still need to report in the UK? Do I still have UK source income, etc., that needs to be reported? And following on from that, the fourth point would be, and do the reporting, do your compliance. So get that tax return correctly. There's a form P85, which you can fill in to tell HMRC you've left the UK. I say they'll probably still issue you with a tax return anyway, but you can always ask for that to be cancelled. And then I guess the sort of last point is, check that national insurance, check how the payroll works with your employer, etc. Make sure you've got everything in a row, because the worst thing is what you don't want is, although you can always get relief under the treaties, etc., you shouldn't be paying tax and national insurance in 2 jurisdictions. You don't want to end up paying them because you got the admin wrong and just having that cash flow disadvantage of having paid tax in 2 places whilst you wait for a repayment. So make sure you know exactly how things will be done so it can hopefully go nice and smoothly.
That's really good, Alex. But there's a load there, isn't it? So I'm taking from that, if there's one message, it can be really exciting because it's sort of brave new worlds, and there's lots of opportunities, but equally lots of tax friction points if you don't do it properly. So plan ahead.
Yeah, absolutely. Always plan ahead.
Yeah, it's never as simple as I'm just leaving the country. That's it. Great. Engage with your professional advisors early to make sure that you're optimizing the position as much as possible and avoiding tax wastage or leakage where possible.
Yeah.
But thank you. That was very interesting. And thank you both for your time. So key takeaway, engage with your advisors early in the process if you are considering moving abroad. So thank you for listening to this episode of the Private Wealth Podcast. At Saffery, we work with a wide range of clients, both in the UK and overseas. We advise individuals and families on how best to safeguard, maintain and enhance their wealth, and on the most appropriate methods of passing on that wealth to the next generation. We also help people comply with the tax laws in the UK, which can be complex. It is important for me to mention that if you're considering any of the topics discussed today, you must always take professional advice based on your own circumstances. If you'd like to find out more about the services we offer at Saffery, then please do visit our website at saffery.com. And don't forget to subscribe on your preferred podcast platform and leave us a review if you found this episode helpful. Thank you for listening.